Welcome to the deep dive. I'm really glad you're joining us for this one today.
Yeah.
Okay, let's unpack this.
Yeah.
I want you to imagine you're just holding this massive freezing block of ice in your bare hands.
Right. And it's just instantly melting.
Exactly. Water is just pouring through your fingers. And if you stand there paralyzed, eventually you've got absolutely nothing left, right? Just wet shoes.
Which is a terrible feeling.
It is. But if you have the right tools, and I guess more importantly, if you really understand exactly how fast that ice is degrading, you can actually carve it into a crystal clear sculpture,
Yeah.
right before it vanishes.
Yeah. And the speed of that degradation, I mean, that dictates your entire strategy. Because in the options market, that block of ice is the contract itself.
Right.
Time doesn't just, pass. It actively consumes the asset you're holding.
Which brings us to our actual mission for today's deep dive. We're looking at how the element of time fundamentally changes the risk, the reward, and just the underlying math of the options market.
Yeah, turning a pretty standard derivative into this hyper-leveraged instrument.
Exactly. And to figure this out, we've got a really great stack of sources today. We're pulling expert market analysis from Stott Gamma and Market XLS, along with some really dense quantitative strategy guides from days to expiry.
And we can't forget the retail side. We've got some pretty battle-tested, sometimes brutal advice from the trenches of Reddit, specifically the Roptions and Theta gang communities.
Oh yeah, some of those Reddit stories are wild.
Yeah.
But to really see this time dynamic clearly, we have to start by looking at the absolute extreme edge of the market.
Right. We have to bypass your standard, monthly or quarterly expirations and look directly at 0-DTE.
0 days to expiration.
Exactly. These are contracts that are literally minted at the opening bell, and they completely cease to exist by 4 p.m. Eastern.
It's just wild to me. Like, whatever extrinsic value they hold is just totally annihilated in a single trading session.
It's a complete wipeout by the end of the day.
And the scale of this is... it's what initially caught my eye in those Spot Gamma and Market XLS reports.
Right.
0-DTE now accounts for roughly 40 to 50% of the total volume for S&P 500 index options.
Which is staggering.
It's massive. We're talking 4 to 5 million of these specific contracts traded daily. This just completely took over the market structure, I think, after the CBOE expanded the expiration schedules back in 2022.
Yeah, they expanded it to cover every single trading day. But, the structural environment really matters immensely here.
Oh, so?
Well, most of this volume concentrates in the SPX, so the actual S&P 500 index itself, rather than, say, the SPY ETF.
Okay.
Because the SPX is cash settled. It's European style, so you literally cannot be assigned early, and you don't have to worry about the logistics of delivering underlying shares at the end of the day.
Because it just settles for cash.
Exactly. It settles for cash. And that clean slate removes the physical delivery nightmare, which makes it really the perfect vehicle for hyper short-term trading.
Okay, but I have to push back a little here, because looking at this purely from a mathematical standpoint, the whole premise seems incredibly hostile to the buyer.
It does sound like a trap, yeah.
Right. Like, you're buying an asset that the math guarantees will decay to zero in a matter of hours. It sounds like playing a game of musical chairs where the music is already fading out. Why is half the market playing this game?
So the draw for buyers is just extreme asymmetric leverage. That and the total elimination of gap risk.
Gap risk meaning overnight exposure.
Exactly. In traditional equity or, long-term options trading, holding a position overnight exposes you to macro events. So, say an unexpected geopolitical headline drops at 2 a.m.
Oh, right. You wake up and your perfectly modeled position just gaps down 15% at the open.
Yeah, and you suffer a massive drawdown with zero opportunity to defend the trade while the market was closed.
Whoa.
0-DTE isolates your exposure entirely to intraday market hours.
You get a clean slate every single morning. That actually makes perfect sense for, institutional portfolio managers. Right?
Yeah. Exactly. If the Fed is releasing minutes at 2 p.m., a fund manager can just buy 0-DTE, puts out 145, to hedge a billion-dollar equity portfolio for just that specific 2-hour window.
And then they just let the hedge expire. They don't need to drag the cost of that insurance into the following week.
Precisely. And then for retail traders who are just taking directional shots, it's really about the raw leverage. Because you are only buying hours of time, the premiums are incredibly low.
So it's a cheap lottery ticket.
Right. A far out-of-the-money contract might trade for, 20 cents. So for $20 of actual capital, you secure exposure to an index move that, if it hits, can multiply that capital 5 or 10 times over in a single afternoon.
And of course, the sellers on the other side are collecting that 20 bucks, basically betting the clock runs out before the index ever reaches that strike.
Which it usually does.
Right. But to understand why these intraday price swings are so violent and why sellers are willing to take that bet, we have to look under the hood at the forces controlling the options prices, the Greeks.
Yeah, the Greeks. Because the sheer compression of time here warps these forces into entirely different beasts.
Let's start with Theta, the actual measure of time decay. Spot Gamma's data visualizes this so perfectly. On a zero-DTE contract, Theta isn't this gentle downward slope. It is a sheer cliff.
100% of the extrinsic value is just bleeding out by the closing bell.
But there was this really crucial nuance added to that decay curve based on an excellent breakdown from the Roptions subreddit.
Oh, right, about how the decay isn't uniform.
Exactly. Time decay is not uniform across all strike prices. If you look at the money option, so strikes right at the current index price, they decay exponentially in those final days and hours, like a stone falling off a cliff.
But the out-of-the-money options, those cheap lottery tickets, they have an inverse curve.
Yes. They lose the vast majority of their value far prior to expiration. It's more like a landing plane gliding down slowly at the very end.
The mechanics behind that divergence are really fascinating because an at-the-money option holds the absolute maximum amount of uncertainty.
Because nobody knows which way it's going to flip.
Right. Until the final seconds of the trading day, no one knows if it will finish in the money or out of the money. So the market prices in that massive uncertainty as extrinsic value.
And when the clock finally runs out, all of that uncertainty just collapses at once, taking the premium with it.
Exactly. But for an option that is deeply out of the money, the mathematical probability of it suddenly becoming profitable is basically zero well before the bell rings.
So the uncertainty leaves early, meaning the premium bleeds out early.
Yeah, and that structural math is exactly why premium sellers are so attracted to short-dated, out-of-the-money options. The probability heavily favors them.
But theta is only half the equation, right?
Yeah.
Because here's where it gets really interesting. We have to talk about gamma.
The accelerator.
Yes. So if delta is the speed your car is traveling, like how much your option price moves for every 1-point move in the stock gamma is the sensitivity of your gas pedal. It dictates how fast your delta actually changes.
And on a zero-DTE contract, gamma exposure is at its absolute theoretical peak.
Right, because on a 90-day contract, you can stomp on the gas pedal, and the car just smoothly, gradually accelerates. The delta shifts slowly. But on a zero-DTE contract,
Gamma makes that gas pedal violently sensitive.
you tap it with a feather, and the car instantly jumps to 150 miles an hour.
And the numbers bear that out perfectly. Spot Gamma highlights that an insignificant 10-point move in the S&P 500, which is literally a fraction of a percent, can cause a zero-DTE options delta to spike so rapidly that the contract's value doubles or triples in minutes.
Which means selling these options for income is essentially picking up pennies in front of a steamroller.
It really is. What's fascinating here is that the exact same gamma that makes zero-DTE an incredible lottery ticket for buyers makes it a catastrophic account-wiping trap for unhedged sellers.
But what absolutely blew my mind in the research is how this local gamma explosion actually forces market makers to physically move the underlying stock market.
Ah, dealer hedging. Yes, this is the crucial mechanism that actually drives the broader market's price action.
Walk us through that because it's wild.
So, market makers, the institutions taking the other side of these millions of retail trades, they are not in the business of directional gambling.
Right, they just want to collect the spread.
Exactly. They want to remain delta neutral. So if a swarm of retail traders buys zero-DTE calls, the dealer is short those calls. They now have negative delta exposure.
Meaning if the market goes up, the dealer loses money.
Right. So they have to hedge.
Which means they are forced to mechanically go into the market and buy the underlying S&P 500 index shares just to zero out that negative delta.
And because of that peak zero-DTE gamma we just talked about, this creates an intense feedback loop.
Right, because the dealer buys the stock to hedge, and that buying pressure pushes the S&P 500 slightly higher.
And since gamma is hypersensitive near 0 days, that slight upward move causes the delta on those short calls to increase rapidly.
Suddenly, the dealer is short delta again.
Yes. So they have to buy even more stock to rehedge.
And that subsequent buying pushes the market even higher, which spikes the gamma again, which increases the delta, forcing even more buying. It's just a mechanical squeeze.
Exactly. The derivatives market, the tail, is violently wagging the dog of the underlying equities market.
It's insane to think about. That feedback loop is what generates the intense intraday volatility we see on heavy 0DTE volume days.
The sheer mass of gamma forces dealers to amplify the market's direction just to protect their own books.
Okay, so seeing how volatile and honestly hostile this gamma trap is for premium sellers, it naturally pushes disciplined retail traders and institutions away from 0DTE when they're looking for consistent income.
They have to retreat.
Right. They back up the time curve to find an environment where the math is much more favorable. Which leads us right into the quantitative data from platforms like tastytrade and the mechanics behind the 45 DTE and 21 DTE rules.
Yeah, when you run massive backtests across hundreds of thousands of trades in various market environments, 45 days to expiry emerges as the statistical sweet spot.
Okay, why 45?
At 45 days, you're entering the trade just as the theta decay curve for at-the-money and slightly out-of-the-money options begins its steepest, most efficient downward trajectory.
Oh, so you get enough premium to make the trade worthwhile, but you avoid that immediate gamma explosion.
Exactly. You are maximizing the rate of decay you can capture, but crucially, that gas pedal, the gamma, is still relatively stiff.
So the market can whip around, the stock can drop a few points, and your position's delta won't violently swing you into a maximum loss. You actually have a mathematical buffer.
But, and this is a massive but, the 45 DTE entry is only viable if paired with the 21 DTE exit rule.
The 21 DPE rule. Let's get into this because the options math shows that gamma risk doesn't increase linearly, right? It compounds.
Massively. As you cross the 21-day threshold, gamma risk can expand 5 to 10 times compared to where it was at day 45.
So professional sellers, they mechanically enter at 45 DTE and ruthlessly exit at 21 DTE, or when hitting 50% profit, just to completely avoid the danger zone.
It's purely an exercise in survival mathematics.
I get the math, but I have to ask. If you're at 21 days and the trade is winning, isn't it just basic human nature to hold on a little longer to squeeze out that last bit of profit? Like, why leave money on the table?
Because of tail risk. Attempting to squeeze out that final fraction of premium exposes you to what's known as pin risk.
Pin risk.
Yeah, in that final week, with gamma at its absolute peak, a completely meaningless 50-cent move in the underlying stock can instantly flip a profitable trade into a maximum loss.
Wow. Over 50 cents.
Over 50 cents. And because you've exhausted your time, you have 0 days left to wait for a reversion to the mean. You're just trapped.
So the 21 DTE rule isn't really about maximizing profit, it's about surviving tail risk.
Exactly. So, right, because the VIX dictates the size of the extrinsic premiums. If the VIX is sitting at, say, 12, which is a totally flat, complacent market, options premiums are incredibly cheap.
So entering at 45 days might not yield enough credit to even justify the capital requirement.
Exactly. So traders will slide down the curve, tightening the window to 30 or 40 days to capture faster decay on those thinner premiums.
And conversely, if the VIX spikes to 30, premiums expand massively. So traders will stretch their entry out to 50 or 60 days to let the market breathe.
Yeah, you're just manipulating time to match the volatility environment.
All right, so we know the time frames now. 0 DTE for the adrenaline junkies, 45 DTE for consistency. Let's transition these high-level mechanics into the actual trenches.
Let's do it.
I want to look at how traders are actually executing this without getting wiped out, drawing on those hard lessons from Reddit. Let's talk about cash-secured puts first.
CSPs are really a foundational strategy here. You're basically leveraging the theta decay curve to get paid for setting a limit order on a stock you actually want to own.
Right. You set aside the cash to buy 100 shares, you sell a put at your desired strike, collect the premium, and wait.
And if time runs out and the stock stays above your strike, the option expires worthless. You keep the premium and you deploy the capital again.
It's structurally sound as long as you genuinely want to hold the underlying asset long term.
But credit spreads, now those introduce a much more fragile dynamic.
They do. With a credit spread, you're selling an option to collect premium, but simultaneously buying an option further out for protection.
So it strictly caps your maximum loss. It defines your risk perfectly on paper.
On paper, yes. But the flaw in relying purely on defined risk is win rate degradation. Because you are paying for that protective long option, you drastically reduce your net premium collected.
So you have to maintain an incredibly high win rate just to stay profitable.
Exactly. One Reddit user actually joked that the secret to winning with credit spreads is just selling the ones that don't end up in the money. Which is funny, but it points to a brutal reality. Taking max losses on spreads will bleed an account to zero, even if the risk was quote-unquote defined.
Which is exactly why the community enforces such strict capital allocation rules. Never risk more than 1 to 2% of your account on a single trade.
Because the cheapness of zero DTE or short-dated spreads makes it incredibly tempting to over-leverage, right? To
Yeah.
sell 50 contracts instead of 5.
And when gamma expands against an over-leveraged position, your account doesn't just draw down, it detonates.
Which ties directly into what might be the most unforgiving rule we found in the Reddit discussions. Never average down on zero DTE.
Oh, absolutely. In traditional equity investing, averaging down by buying more shares when a stock drops, it lowers your cost basis. It's valid.
Right, it's classic long-term investing. But applying that logic to a zero DTE option is like, it's throwing water on a grease fire.
It really is mathematical suicide.
We literally saw a post where a trader lost over $1,500 in a single afternoon trying to average down on a SPY position. When you average down on a dying option, you're actively increasing your exposure against an accelerating theta curve.
While also expending your negative gamma, you're giving the explosion more fuel while the clock is just running out.
But even if you don't do that, even if your directional assumption is eventually proven right, there's another structural reality that breaks standard Black-Scholes modeling.
The liquidity trap.
Yes. A Reddit user correctly pointed out that the ultimate unassailable truth of the options market isn't the theoretical math. It is the bid-ask spread.
It doesn't matter what the model says your contract is worth. The price is strictly dictated by what a counterparty is actually willing to pay.
And as the 4 p.m. closing bell approaches, market makers begin aggressively flattening their books. They do not want to carry unhedged risk into the closes.
So as they step away, liquidity in the options chain just completely evaporates. The gap between the bid price and the ask price widens drastically.
Meaning, if you have a rule to close zero DTE positions, you better do it before 3 p.m. Because if you're holding at 3:30 and decide to exit, you're forced to cross this massive bid-ask spread.
Yeah, you end up giving back a huge portion of your profits or compounding your losses simply to find the liquidity to get out.
The mathematical profit on your screen is just an illusion if the liquidity isn't there.
You're paying a heavy premium just for the privilege of closing the trade.
So what does this all mean for you listening? I think the core takeaway here is that time in the financial markets isn't linear. It's a curve that accelerates.
It is an active force.
Right. Whether you are actively selling cash-secured puts at 45 DTE or honestly just holding a standard S&P 500 index fund in a retirement account, you are swimming in a market where zero DTE gamma and dealer hedging are moving the currents beneath you.
The derivative tail is steering the underlying market.
Exactly. But before we sign off, I want to leave you with one final kind of provocative thought that builds on this dynamic. We spent this whole deep dive talking about how retail traders fear these violent gamma swings near expiration.
But institutional market makers, they actually harvest it.
It's called gamma scalping. Walk us through this really quick because it's brilliant.
It's the ultimate mechanical exploitation of volatility. A market maker will put on a delta neutral position, which leaves them holding massive positive gamma.
They actually want the market to swing violently.
Yes. If the S&P 500 drops sharply, the delta of their put options increases. They now hold negative delta. To return to neutral, they mechanically buy shares of the index at that lower price.
And then, when the index violently rebounds an hour later, their calls gain delta.
Right. They are now holding positive delta. So to get back to zero, they mechanically sell those shares at the higher price.
They are continuously buying low and selling high, driven entirely by the mathematical mandate to remain delta neutral.
And they use the cash generated from scalping those chaotic price swings to pay for the theta decay they suffer on the options.
They aren't predicting direction at all. They're literally just using the chaos of the market to pay for their theta decay.
It just shows you, in the market, one trader's ultimate risk is another's perfect engine for profit.
It really is. The ice block is melting for everyone, but it just depends on how you manage the decay. Thank you so much for joining us on this deep dive. Keep looking under the hood of these market mechanics, keep questioning the structures around you, and we'll catch you on the next one.